Hey, good day, everybody. My name is Jim Kinney, and I will be conducting the webcast here today. Before we get into the managed futures, I did want to mention to everyone that in addition to the managed futures, there are contracts and options available on a wide variety of markets. And some of you may be interested in looking into that further. Markets such as the S&P 500 stock index or other stock indexes would be available to suitable investors. And of course, the stock market this week has been in an increased volatility. The geopolitical situation, the earnings reports, and other factors have come in and created a certain amount of volatility this week. So those of you who are interested in trading one of the stock indexes, that is available. Secondly, the U.S. dollar, which has been fairly stable around 98 or 102 lately. Some people have a view that the U.S. dollar may be moving up or down sharply. There are contracts and options available on that. And then, of course, you've got the oil markets and the energy markets. Oil prices were in a range for a while, 57 to 53, dropped down towards 47, 48. And they're currently trading between the 47, 48 area and the 53, 54. Some people may have an interest in an energy product, be it natural gas, oil, or gasoline. With regards to interest rates, we did have a Fed hike came out last meeting, and yields, rather than rising, have been falling, which has surprised some people. And of course, the future of how interest rates will go is unknown, but some of you may have an opinion on where you think Treasury bonds or Treasury notes or instruments like that might be going. So they're available as well. And then not finally, but in addition, you have the gold and silver. Obviously, the geopolitical situation has caused a bit of a bid in the gold and silver. Conflicting that, of course, because every market has an up and a downside potential. The stronger dollar that has been stable and the inflation, which has been relatively low by many standards, has been a problem for the gold. And it's fighting that off with the geopolitical, and maybe people are changing their tune on where inflation and the dollar might be down the road. But they certainly had more volatility this week because of a number of factors. If you have an interest in contracts or options on that, they're available as well to suitable investors. And agriculture, we had a grain report that came out from the USDA, which was rather bearish for some of the markets, such as soybeans, but those markets had sold off in advance of the report. And so there has not been currently a significant follow through after the report. And now there's some attention being put towards the summer growing season and whether there might be some hedging against things that might be problematic for some of the people that are delivering the grain. But again, I'm going to give you a phone number. And if you could write that down, that'd be great. 702-873-5707. 702-873-5707. Information can be provided to you, and you can see what, if any, of these strategies and contracts or options might be right for you or absolutely not right for you. Okay? All right. By way of introduction, my name is Jim Kinney, as I said, and I am the branch manager at High Ridge Futures for High Ridge Futures. High Ridge Futures, HRF, is an introducing broker. They have a clearing relationship with ADM Investor Services, which I'll discuss further at the end of the broadcast. Quick background on myself. I'm a graduate of Boston College, and I have been registered with the NFA for over 30 years. I passed examinations for Series 3 and also Series 30 for branch manager. And I do believe I'm qualified to explain the uses and the risks of using managed futures in portfolios for suitable people, which I'm going to do here today. Okay, the next slide, I'm going to have a number of slides here, so bear with me as I try to negotiate them up properly here. And sometimes that's easier said than done. And the first slide, at any rate, is going to be the CFTC disclosure statement, which we start every broadcast out with. And it is a disclosure document, or a statement, not a document, but it's a disclosure statement that goes over different things that you need to be aware of when you look into this type of area. One area that you have to be aware of that is that the trading in this area is not suitable for all people and all investors, and that there is a risk of loss. In some cases, can be substantial risk of loss, no matter who manages your money. And then, of course, there is a disclosure document on the managers that I will be showing to you. And of course, there's more comprehensive disclosures on the methodologies of the managers, the risks involved, the fees involved, the incentives that they get, the backgrounds of each specific CTA. So there is a lot in the disclosure document that cannot be covered in a brief statement from the CFTC disclosure statement. But there you go. There that is. And of course, further disclosures will be coming forth as you look further into it. Okay, right now, the next slide, if I can get that going, is thought-provoking questions. Now, what I'll be going over now is comparative studies, okay? And comparative studies are going to be using an index of managed futures, or CTA accounts, and basically comparing it to a stock index. Now, whether it be the S&P 500, the Dow, the NASDAQ, the Russell, the KNIFE, or the composite, or anything else, it's not going to include every single stock. So that's one of the limitations right off the bat. Likewise, the CTA indexes that they work with, which could include things from the Barclay Index and the Autumn Gold and other indexes as well, will be limited in their universe. So it's for illustrative purposes to show you how an index of the managed futures would go against a stock index in a number of different environments. And basically, you do have to remember that the limitations, again, are that they're not going to include all the managers and all the stocks in the world. And your results, your specific results, individual results, may vary in some cases substantially from the illustrative examples that I'm showing you. Okay, but here's some of the things we're going to compare real quick. We are going to go over the 5 worst periods for stocks since 1987 and compare it to the managed futures. By the way, at the end of the broadcast, I will be coming to you with some specific advisors that I work with that I would suggest to people that are suitable and qualified to look into. So do stay with us here to the end so I can get that information to you as well. But anyway, this comparative study, which I'll have a number of slides on right now, are as follows. The 5 worst periods declines for stocks since '87 versus the managed futures. The 15 worst quarters for stocks over the past 25 years versus the managed futures. And the most critical events that have occurred in the last 35 years versus the managed futures. And then, of course, the very worst stock market declines in history since 1987. And, of course, against the managed futures. A couple of other comparisons will be the past 25 years, a portfolio diversified with 20% with managed futures compared to not having them at all and just having stocks and bonds. There'll be a slide on that. And then finally, over the past 35 years, what has the managed future indexes done as a performance versus international and domestic stocks? So again, we will be going over some graphs, some slides on that, and some of you may find that quite interesting. One thing we are going to talk about right away also is as an asset class, people applying part of their portfolio to managed futures has had a very, very significant inflow of capital in the last 15 years. In fact, the number is up 771%. Through the first quarter of 2015. So it doesn't even include 16 or where we are already today. But that's a heck of a jump, and I'll show you a slide on that now, and you'll be able to get an idea of what's going on there. Let's go to the next slide here. But before we do, let's give a basic explanation of what the managed futures are all about as far as how do they work? Well, a managed futures account is one where a registered CTA, commodity trading advisor, is given responsibility for all trading decisions, and this authority is delegated by the account holder to the CTA through what is called a limited power of attorney, which can be withdrawn at any time. Now, these gentlemen, the CTAs, are registered and licensed, which separates them from quite a number of people you can run into on the internet who are neither. So the CTAs are registered with the CFTC, the Commodity Futures Trading Commission, and they are also members of the NFA, which is the hold on a second here. Let me get the slide going here. The NFA, which is, there you go, which is a government agency. Well, the CFTC is an agency of the federal government. The NFA is a self-regulatory organization organized or authorized by Congress in 1982, as it says right there in front of you. Okay, so people use the managed futures in a wide variety of type of accounts. Some are using the qualified retirement plans like IRAs, trusts, and pensions. So as I get into it further, you'll be able to get more details on that. Let me see if I can get the slides working here a little bit better. And the next slide, again, was the one that I was referring to, which is the growth of assets coming into the managed futures industry. There's the graph, and obviously that's very significant. It shows you in the last 15 years, assets under management for the managed futures industries have grown approximately 771%. The graph kind of gets going right after the crash, the dot-com crash, if you notice. We have the dot-com crash right around 2000, and then by 2002, 2004, you start getting some acceleration. And then, of course, in the subsequent years, of 2008, well, after actually you got another big leg up right after the last crash. So the first crash of dot-com, that got a good leg going on the upside, assets coming into this asset class. And then the next time you had a crash, you had another big leg up. So people obviously are saying to themselves, I've got stocks, I've got bonds, and for suitable, appropriate people, they're saying managed futures in there might not be a terrible idea, or they're at least going to give it a go. Okay, so there you have that chart. Let's go to the next one, but that's a fairly dramatic increase in the assets into this class. Okay, so the next one is growth again. There you have the numbers again. In 1980, they had less than $1 billion. 2000, $37 billion, and as of the first quarter of 2015, we're way above $300 billion. So those numbers are they're coming in pretty big. Okay, now let's go over to some of the different charts here. This one is going to be the comparing. This is a study that was done by a gentleman, the late Harvard professor, Dr. Littner. And basically what his study was saying is that when managed futures are involved, it can increase the performance and reduce the overall risk. The idea behind that, and for every specific situation, but the idea behind this is that it's a non-correlated investment, meaning it's not going to go exactly the way stocks would necessarily, nor the same way that bonds would go. And so since they're not exactly in the same thing as bonds or exactly in the same thing as the stocks you might own, it does prove to be a diversification, and the non-correlated situation can be helpful to diversify the risk. And in some cases, if you get good performance out of the managed futures specialist, then of course it could help the performance as well. That's the concept there. Okay, there's some details on the performance of the B Top 50, that's the Barclays Top 50 Index. Again, these are indexes, nothing specific here, just like when they're comparing it to the S&P. It's not one stock, it's a basket, same idea. So this is for illustrative purposes now. But you can see that the performance of the index versus the 15 worst quarters for S&P are favorable to the Managed Futures Index. And let's go to the next one here. And the next one has to do with Autumn Gold Index, could be when they've had quarterly losses of greater than 10%. And again, when the stocks have had greater losses than 10%, the Autumn Gold Index seems to have performed pretty well in comparison. So that's another comparative study with the Autumn Gold CTA Index versus the S&P. Okay, the next slide is going to be on critical events. Now, what are critical events can be? Hold on here. Let me get the thing down a little bit further. Yeah, critical events can be things like the crash, and it can be things like the Persian Gulf War, can be long-term capital management getting nailed for $4.6 billion. It can be 9/11, the horrific 9/11. It could also be the subprime mortgage crisis that we had in '08, which obviously was the big granddaddy of them all, right? And then, of course, the U.S. debt downgraded to AA in 2011. That was no day at the beach either. Well, what it's showing to you is that if you compare the index of managed futures index, like the Barclay CTA index, to the S&P, or in this case, it's the Dow Jones Industrial Average, it's a favorable comparison during that period of time where we've had critical events. And that's the idea behind that slide. Okay, the next one here is declines of history. And let's see how that takes a look here. There you go. Crash of '87, the tax, Iraq, they're all the ones that I mentioned, before. There you've got a numerical comparison between the Barclay Top 50 and the S&P during those periods of time. So again, these are reasons why people have sought out managed account futures as a diversification. No assurance that it's non-correlated, but that's the concept, that it's non-correlated. And then basically, how it can diversify your risk and change the risk in your portfolio. Okay, next slide is going to be on the effect of allocating 20% of traditional stock and bond portfolio to the managed futures. Again, using indexes as a comparative illustrative study. The bonds are the Barclay U.S. Aggregate Bond Index. Used to be called the Lehman Index, but we all know why it's not called that anymore. And then you've got the S&P, and then they are using an index with autumn gold. Okay, and as you can see, there's a favorable comparison in that study as well. These are illustrative examples of using an index of CTAs and managed futures accounts and against a basket of stocks. So again, your specific results may vary, and in some cases may vary substantially. Looking at a 35-year a 35-year study comparing managed futures and stocks, and as in this, the managed futures are using the Barclay CTA index, and basically this is an index. There are 135 programs involved, so it's not everybody. And of course, the Dow Jones Industrial Average is 30 blue chip stocks. That's hardly everybody. And then it's comparing the international, which is an index of international equities, 22 major developed markets, excluding US and Canada. Okay, so as you can see, the study showing a favorable comparison, and so that's some information for you to have to compare and get some understanding why some people who are suitable and interested would consider diversifying some of their money into the managed futures after they got all the disclosures and after they got the information. Again, there's your risk reduction, and the idea here is that the correlation with your stock and bond portfolio is not going to be high. Now, there's no assurance that's the case, but that's the concept. And because of that, it may go in a different direction than your stock or your bonds. And at that point, it could give you a different risk profile and a different return profile in your portfolio. Okay, this next one here is amateurs versus the professionals, okay? And in here, basically what they're saying, let me try to get the slide as evenly as I can. What they're saying is, according to some studies, a lot of you guys out here who come to a broadcast or are interested in things, you're doing all your own thing. You want to, do your own stocks, do your own options, do your own everything. And again, studies have shown that some individual investors who have the know-how, the time, the access to information, and the temperament, they can be highly successful in directing their own accounts, particularly on futures. Unfortunately, what the record shows is that only a small percentage that can do it on their own, futures traders in general, possess these requisites for success. So studies are indicating, that it might make sense to diversify part of your capital to a professional money manager rather than just try to do every single thing on your own. Based on your suitability, the size of your portfolio, and other factors like that. But again, this is why people look into it. Now, since we're on the page here of amateurs versus professionals, what I'm going to talk about 3 professionals that I've zeroed in on. Now, at HRF, we have a number of advisors, and I've zeroed in on 3, which I'm going to discuss with you right now. Okay, so I am going to discuss with you is called the White River Group, and they have 2 programs. One program is called the Stock Index Option Writing Program. Okay, now this program goes all the way back to 2008, and through February of this year, the results, in my view, have been attractive. Now, again, don't forget, as a disclosure, past performance is not necessarily indicative of future results. So everything I'm talking about has already happened. And that does not mean they're going to happen again. And so that's why past performance is not necessarily indicative of future results. Okay. And again, these investments, like any investments, are not right for everyone. All right. Now let's proceed. So with regards to the start date, this one started on November of 2008. And through the end of February, the total return since inception was 157.53%. The compounded annual return has been 12.02%. So those are fairly good historical numbers. Again, historical is the operative word, okay? And now, in addition to that, the winning months versus losing months I find attractive. So out of 100 months that this program has been available, 81% of the months, 81 out of 100 months, have been profitable. So obviously there is a strategy being employed here that has worked out on a percentage basis quite high. The manager of this program, his name is Andreas Diesbacher. And again, he has for those of you more sophisticated in the area to begin with, the Sharpe ratio for 3 years is 0.46. The Sterling ratio 3 years is 0.33. Cumulative, Sharpe is at 110, and the Sterling is at 0.33. Now, the Barclay ratio for 3 years is 0.36, cumulative 1.35, and the efficiency is 0.48, and the cumulative is 1.12. Now, again, these are all historical numbers, but many people have looked into this and have obviously employed this manager to work with part of their capital. These managers are compensated on a number of fronts. One of them is a percentage of profit. They have an incentive, and they are on net new profits. Now, this is covered along with many, many other things in the disclosure document. So I'm not trying to circumvent the DDoC, because that is not you need to go through the DDoC, the disclosure document. But it is important to know that they have a vested interest in the equity rising, right? And if there are losses, the incentive is suspended until the losses are made up. So there is these managers are very much tied to the equity rising and falling, and I find that, as a personal view, as a personal opinion, very attractive. So that's the first program, the Stock Index Option Writing Program. Now, in about 2014, he came out with an additional program. He changed the parameters of his trading as far as the amount of days that he works with on his options and the striking prices that he chooses. And he tweaked the original program from its original situation. And this second program is called the Dynamic S&P Option Strategy. Dynamic S&P Option Strategy. Now, in the 28 months that it's been going, the total return since inception is 30.48%, and the compounded annual return is 12.08%. The winning versus losing month, though, is the one that jumps off the page a little bit here. In the 28 months, that doesn't count the month of March, 27 months have been profitable out of 28 months. His Sharpe ratio, again, for you sophisticated people who understand that, what that is all about, the short explanation, and it is a short explanation, is that these are numerical measurements that are trying to give you an idea of the risk-adjusted return. So basically, that's why people look at these ratios when they're considering these managers. So anyway, his Sharpe ratio is 1.43, cumulative the same, 1.43. Barclay 3 years at 192, and so is the cumulative, and the efficiency index is 145, and so is the cumulative. So again, this is the record of the dynamic S&P option strategy. And again, it is being managed by the White River Group and Andreas Diesbacher. Now, again, I've gone over it before. I'll go over it again. This is all historical documentation that has occurred. So past performance is not necessarily indicative of future results, but I think it's worthwhile to take a look at this guy and see if, in fact, you're suitable and see if, in fact, it's right for you. And if you'd like to include him as part of your portfolio in a program that is different than what you're doing in stocks, bonds, and in your own trading. If your portfolio is large enough and you are suitable enough, then this may make sense for some of you that are there listening today. Okay, the next gentleman, so that was the White River Group. The next gentleman who I am zeroed in on is called Pacific Front Capital. And here, this gentleman is utilizing proprietary models to generate trade ideas for relatively short-term periods of time. Now, the difference between him and White River is significant on many fronts, but one front is that the track record is only for last year. But last year was quite a good year. And again, past performance is not necessarily indicative of results, but here are the numbers going back to 2016 for the program from Pacific Front Capital. First of all, the omega ratio, which is another ratio, how they gauge the manager, is 9.88. The Sharpe ratio was 2.68. The Sortino ratio is 9.58, and then the profit loss ratio is 10.66. But here's how the results have worked out. His worst monthly drawdown last year was 9.58%, and that was also his peak to valley drawdown, so 9.58%. His average monthly return was 10.28%, and basically his gain to loss ratio was 1.33. His total return for the year was 128.45%. So that was obviously a very outstanding result. And that's why some people are looking into what he's doing, how he does it, and how it might be or not be appropriate for them. Now, again, this is a one-year record of 128% and change. And it is, again, past performance is not necessarily indicative of future results, but there have been a lot of people who are suitable, who have assets that would make this investment possible as a diversification. And they have looked into this manager. And again, for those of you who fit that profile, I don't think it would be a bad idea to investigate this manager as well. The third manager that I've zeroed in on is for QEP investors only. Now, when I say QEP investors, what does that mean? It means qualified eligible persons. And so I cannot go into the specifics of this manager until there is documentation that has been signed off that you are a QEP and that this information is suitable to provide to you. Those of you who are, again, I'll give you my number at the end of the broadcast. If you'd like to call and let me know that, we can set up a situation where you do give us the form that's needed. And then, of course, the information flow can start. But if you are a QEP, this gentleman, I believe, has a very good history, which does not mean the future performance by any means, but he's got a good history that I think is worthwhile to investigate to see if, it might be right for you. And again, that's for QEP. So those are three advisors that I've zeroed into that I think are worthwhile to take a look and see if in fact it might be right for you. Again, you're trying to get a diversification when you work with these managers. You are trying to get a non-correlated. There's no assurance that that'll occur, but there is a situation where you're trying to get a non-correlated investment to go along, because we saw the bond market come off pretty hard from last year. Then it had a big bounce up lately. Stocks, of course, had big run-ups after the election. The bloom has come off the rose a little bit lately. Lord knows exactly how things will pan out. But again, if you'd like to have an alternative investment in your portfolio, then this is something that people look into for exactly that reason. Okay, I'm going to go to the next slide here. And again, all these advisors, part of their compensation profit, so they have a vested interest in your account growing. And if there are losses, because it has to be on net new profits, you are in a situation where the profit participation is suspended until the negative is made up. Again, that is a very brief explanation. In the disclosure document, you have a much more comprehensive explanation. And of course, you're going to be encouraged to look into that. Okay, let me go down here and see what I got. Say you decide, well, let's just see here. Yeah, one of the common mistakes people have is about different. I've had a long history in the investment field. And even if you haven't, even if you had you sometimes can get lost. And I don't know that this is as prevalent as it used to be. But it used to be a situation where somebody would be in stocks, and then you have all these mutual funds, and then they would look at these mutual funds, and what would they see? They would see that a lot of the stocks in the mutual funds are the same as the other funds they own, and they thought they were getting a big diversification. They found out they're pretty much in the same kind of stocks. Or they thought that some stocks won't go in the same direction if the market goes up or down. Or they're in bonds, and they thought that certain bonds might be immune from interest rate hikes, or they might be immune from other volatile situations. What they find in some cases is that's not true, and that diversification that they thought they had is not really giving them the shield from volatility that they thought or were told that it might. So again, when you're putting managed futures in there and a trading advisor in there in a non-correlated investment to the stocks and bonds you already own, the situation is hopeful that that non-correlated diversification will help with risk in the portfolio and performance in the portfolio. While there's no assurance of that, that's the objective that we're trying to get to. Okay, all right. Let's talk about the next situation here. Tax benefits. Okay, this is a big one for me because it's tax time and you got what you owe on some things. Are there tax benefits to investing in this type of vehicle, managed futures? Well, the answer is yes. According to the Tax Act of 1981, short-term profits in commodities, which this is under that asset class, they're treated 60% long-term and 40% short-term. On the other hand, short-term trading profits in stocks are treated as 100% short-term. Now, a short-term investment is categorized as something that's held for less than a year. Now, that can translate into, and the people in the upper brackets, as much as a 30% break on taxes in short-term gains versus stocks in this asset class versus stocks. Now, we always say this, and never forget this: you must consult your tax advisor regarding your individual tax situation. But there is something to be said for getting a tax break on the gains that are generated in this asset class versus the stocks. So that might be something some of you would put into your think tank as well, particularly as we're in tax time now and you're going through all your numbers. Okay, say you decide to go ahead and you work with and you want to work with somebody. Okay, and you go through the disclosure document and you look into it further and you go, you know what, I think I'd like to diversify into one of these managers. Or what you can do is use more than one managers if you have the wherewithal and the suitability. In other words, some people set up a manager of managers, which means you have a certain amount of money in there, And just like you would in other investments, you have more than one manager working in the asset class, right? Okay, but say you decide to move forward. You're going to have some questions, obviously, of a basic nature. One would be, where's my money kept? Well, your client assets on this are held in a customer segregated account by ADM Investor Services, which is an established financial institution in business for over 50 years. So that's where the money is kept. That's where your funds are domiciled. Now, how accessible are my funds in the managed account? Again, this is a liquid investment. And although we strongly advise, obviously, that you stay with the managed account if you feel like it is right to do, so that the strategies have time to work with their probabilities. But it is your money, and you have the right to get to your money from a situation. Either part or all of the funds can be available to you. So that is something to be. There's a high degree of liquidity here in most cases. Obviously, not every single case. Is the money in the account safe? Well, your funds are kept in the segregated account in your name, and CFTC regulations prohibit the FCMs from commingling segregated funds. But the segregated funds does not guarantee safety against losses. That has to be said, although it's pretty obvious. So you'll still have market risk, but the actual funds are held in a segregated account at ADM Investor Services, a company that has been in business for over 50 years. Okay, let's see what else I have here. Okay, the other thing is how do I view it on a daily basis, and how do I know or how do I follow it? Well, it's pretty simple, and most of you guys have accounts now, so it's pretty similar to how you follow it now. The first thing is you will have a portal, okay? And you're going to be able to view your account online every day. You have your own positions here. This is not a pool, okay? Everyone has their own individual account. So you'll have your own positions in your account. You'll go online, you go through your portal, username, passcode, the same idea, password, and then bam, you can look at the account right online. Now, if there's activity in the account, right? There's activity, you are going to get statements. So you're going to receive what they call activity generated statements. And then if they're at the end of the month, you'll get a monthly statement. So how can you keep track of things? Pretty easily. You go online and check your account any day. You got an activity generated statement coming out to you if there's any trades done, and you've got the end of the month statement coming to you. Okay, so there's 3 good ways for you to keep in line on what's happening, and that's the way people keep track. Okay, now again, I'm just going to go back to the tax screen here. So some of you people that are going through your taxes right now can read this up again, because I think for higher net worth people, this is something that is of significant nature to some people. Could be, right? Again, the tax benefits involved, according to the Tax Act of '81, you can see it right there on your screen. Short-term profits in commodities, which is the asset class we're talking about, are treated as 60% long-term, 40% short-term, rather than or in comparison to the 100% short-term that is the tax treatment on the stocks and stock activity that's held less than 1 year. Okay, again, check out with your advisor for taxes your specific situation and see if in fact this means anything to you. But it might, and that's why I do bring it up. All right. Now, again, this was a brief explanation of the managed futures and, of course, those trading advisors, those CTAs that I mentioned. I'm inviting you to take my phone number down. My name, again, is Jim Kenney, Kenney. And the phone number is 702-873-5707. Again, this asset class is not right for everyone. And to find out if it might be right for you, realizing past performance is not necessarily indicative of future results, you can get the tear sheets, which will show you a lot of information, some of which I could not go over here in this brief broadcast, on the track records. And, of course, the disclosure document would be made available as well. And for those of you who are QEPs, those are qualified eligible persons, I'd be more than happy to show you that third advisor if you give me a call. Again, Jim Kenny, phone number 702-873-5707. Have a very happy Easter, everybody. And until we speak again, good luck and good trading. And I'll be here at that phone number I gave you for a period of time now if you'd like to call. Otherwise, we'll be back at it on Monday. Have a great weekend.